Invest like the greats, Buffett, Dalio, and more. Ray Dalio. From the moment you decide to learn the art of investing from the masters, your journey gains a new pulse. Picture yourself seated at your desk before sunrise, a steaming cup of coffee in hand, notebook open. The world outside is still hazy, but inside you brim with purpose. You are about to step into the shoes of legends Buffett, Dalio, Munger. Lin Chan claimed the mindset that turned modest stakes into fortunes. You begin by recalling the tale of a young Warren Buffett who at 11 bought his first stock. He didn't chase hot tips or flashy fads. He studied the business, read annual reports, and waited patiently for Mr. Market to undervalue what he knew to be solid. You ask yourself today, what is the true value in the ventures I back? You sketch out 3 companies you understand deeply, perhaps a local bakery expanding its wholesale arm, software startup solving a niche problem, and a renewable energy fund poised for growth. You resolve to learn their numbers, their moats, and the psychology of their founders. In the following days, you channel Ray Dalio's radical openness. You host a thoughtful disagreement session with peers, other investors, mentors, or fellow founders. You lay out your investment thesis for each prospect and invite critique. Someone points out regulatory risks. Another questions your revenue projections. You listen without defensiveness. You note every dissent and refine your model. You see that Dalio's edge lies not in being unassailable, but in embracing the chain of reasoning that leads to the best idea, even if it contradicts your own. A week into your practice, you spot an opportunity. A small logistics firm struggling under legacy systems. You remember Charlie Munger's counsel that the best thing a human being can do is to help another human being know more. You reach out to the founder. Over coffee, you learn that frustration with transparency and real-time tracking holds back growth. You offer to connect them with a developer you know. In return, you negotiate a small equity stake at a modest valuation. You sense the power of alignment. When you help a business solve its core pain, you plant the seeds of mutual success. 2 weeks pass, and you find inspiration in Peter Lynch's Invest in What You Know mantra. On your commute, you notice a new cafe chain that seems crowded every morning. You strike up conversations with baristas and customers. You learn that their secret is not exotic beans, but a seamless mobile ordering system that slashes wait times. You pore over their filings and model scenarios. Could that system be licensed to other chains? Your conviction builds. You allocate a portion of your capital to their public shares, confident that you hold an informational edge others overlook. By the end of month 1, you face your first setback. The logistics firm hits a roadblock. Required permits stall the rollout. Could sit back and lament. Instead, you recall Buffett's patience. He once sat on cash through years of market euphoria, unwilling to overpay. You convene with the founder and help navigate local regulations. You tap your network to fast-track approvals. The delay tests your resolve but also cements the partnership. You learn that perseverance underpins every investment thesis. In month 2, you deepen your practice of risk parity, a principle Dalio champions. Rather than pouring all capital into a single bet, you diversify across assets, equities, bonds, real estate, even commodities. You set up allocation buckets and rebalance monthly. You resist the urge to chase sunken ships when one sector dips. You hold fast to your strategic mix, knowing that balance smooths out storms. When tech shares wobble mid-month, you lean on bond holdings to stabilize returns. You relish the calm that comes from disciplined balance. Midway through the second month, you receive an invitation to pitch at a local angel investor meet. You decide to focus on companies you've studied deeply. One pitch resonates. A health tech platform using AI to predict patient no-shows. You recall Lynch's advice to invest in growth where it is. You probe their unit economics, retention rates, and regulatory pathway. You negotiate a small investment alongside a lead investor, securing a board observer seat. You commit to meeting monthly to monitor progress. You feel the thrill of active participation, of not just writing a check, but steering success as month 3 dawns. You face the temptation of market timing. Stock prices soar on macro headlines. You find yourself torn between fear of missing out and fear of overpaying. You catch yourself scrolling financial news compulsively. You remember Buffett's counsel, time in the market beats time in the market. You pause the news alerts, revisit your chosen assets, confirming that their fundamentals remain sound. You shift your focus back to research, connection, and execution. A new rhythm emerges. Every morning you review your positions and note any new developments. Every week you host a principles review with yourself, echoing Dalio's practice of reflecting on decisions. You log each win and misstep in your journal. You ask, what worked? What didn't? How can I refine my approach? By month 4, you experience the power of compounding relationships. The baristas at the cafe chain introduce you to their coffee roaster, who seeks expansion capital. Your prior investment lends you credibility, and you broker a deal that brings 10% ownership to your portfolio. You see how trust accelerates opportunity? But with expansion comes risk. The coffee roaster's new plant suffers equipment failure. You draw on Dalio's concept of believability-weighted decision-making. You convene a meeting with engineers, operators, and the founder. We weigh each perspective against track records. You craft a repair plan that minimizes downtime and controls costs. The plant rejoins production ahead of schedule. You breathe easier, reminded that effective investors do more than money, they add wisdom. As spring turns into summer, you face a market correction. Headlines scream recession. Your equity-heavy bucket dips sharply. You resist panic. You recall Buffett's famous quip that be fearful when others are greedy, and greedy when others are fearful. You channel your inner contrarian. You identify a beaten-down consumer staple with stable cash flow. You add to the position at a discount. You feel the surge of opportunity that only market turbulence can deliver. At the 6-month mark, you look back on your journey. You tally returns. Some positions soared, others underperformed. Yet your portfolio is healthier, more resilient, and more diversified than when you began. More importantly, your mindset has transformed. You think in probabilities, embrace feedback, and balance conviction with humility. Month 7 brings a personal trial. Your partner falls ill. Time for due diligence vanishes. You could abandon your strategy. Instead, you integrate Buffett's long-term view with Dalio's concepts of risk and cycles. You delegate daily monitoring to a trusted friend in your investment circle. You schedule weekend reviews and keep channel open for urgent calls. You realize that robust systems withstand personal emergencies. By month 8, you emerge stronger. Return to due diligence with renewed clarity. You revisit your small logistics firm, which now thrives under its new permit. You meet with management to plan next stage scaling franchise opportunities, technology licensing, and potential exit strategies. You help craft a 5-year roadmap. You feel the pride of an active investor shaping growth. In month 9, you confront overconfidence. Again, you notice a shiny new tech IPO grabbing headlines. Jewish-themed social media buzzes about a can't-miss blockchain platform. You recall Dalio's warning? No one has a perfect model. You circle back to your principles, invest within your circle of competence, demand a margin of safety, and seek disconfirming evidence. You dig deeper and find hidden governance risks. Pass on the IPO, preserving capital for better opportunities. Months 10 and 11 unfold as seasons of refinement. You mentor to promising founders, one in sustainable agriculture. In teaching them, you solidify your own knowledge. You practice Dalio's idea, meritocracy. You listen more than you speak, weighing their insights with your hard-earned lessons. You learn that teaching is the ultimate test of mastery. As the year's end approaches, you prepare a year-in-review dossier. You summarize each investment's thesis, performance, and outcome. You reflect on emotional peaks moments of doubt, fear, exhilaration. You distill 5 key lessons. Know what you own and why. Like Buffett, you hunt for value in businesses you understand. Embrace radical transparency. Like Dalio, you seek honest feedback and weigh ideas by merit. Invest in what you see every day. Like Lynch, you spot growth where others walk past. Balance risk and reward. Like Dalio's risk parity, You diversify to protect your downside. Compound relationships. Like Munger, you know that the best returns often come from helping others. Succeed. On the final morning of your first year, you sit once more at dawn, coffee at hand. You review your dossier. You feel gratitude for lessons learned and eagerness for the year ahead. You know that the masters you followed, Buffett, Dalio, Lynch, Munger, did not rest after their first decade of success. They built upon each triumph and setback, compounding wisdom as surely as capital.